It's the rumbling of a recession. Can you hear it? As the world holds its breath, markets tremble. Economists whisper in hushed tones. Is a recession lurking around the corner ready to pounce? The answer isn't as simple as a yes or no. It's a game of economic hide and seek, with clues scattered like breadcrumbs along a trail of uncertainty. We see storm clouds gathering. Inflation still simmers, albeit cooled slightly from its recent boil. Interest rates are up, making borrowing as appealing as a bowl of cold soup. The stock market, that fickle beast, swings wildly, fueled by fear and whispers. But is this just a blip on the radar? A temporary economic indigestion? Or are we staring down the barrel of a full-blown recession, complete with job losses, market crashes, and enough economic doom and gloom to make even the most optimistic soul reach for the antacids? Buckle up, dear viewer. We're about to delve into the murky depths of economic indicators, explore the potential fallout, and most importantly, arm you with the knowledge to navigate these uncertain times. Ignorance might be bliss, but when it comes to your finances, knowledge is power. The economic crystal ball. Cloudy with a chance of recession. Predicting a recession is like predicting the weather. We can look at the signs, the data, the historical patterns, but there's always unpredictability. Some economic indicators are flashing red. First, let's talk about the inverted yield curve. It's when short-term interest rates are higher than long-term rates. Historically, it's been a reliable predictor of recessions. Then there's inflation, nibbling at our wallets. Too much tightening could choke off economic growth. And the housing market? Higher mortgage rates and a cooling market. What about the whispers of unemployment? Is it a sign of things to come? One of the most significant indicators of a recession is rising unemployment. When businesses start feeling the pinch, they tighten their belts, and often that means layoffs. And when people lose their jobs, they have less money to spend, which further slows down the economy. It's a vicious cycle. Now, the good news is that the unemployment rate is currently relatively low. But there are whispers, rumors, shadows lurking on the edges of the job market. Layoffs are happening, particularly in certain sectors like tech and finance. Is this a sign of things to come, or just a blip on the radar? It's too early to say for sure, but it's something to keep a watchful eye on. If those whispers turn into screams, it could be a sign that the recessionary winds are picking up. Could you be coming down with something, or is it even worse? Ah yes, it's the housing market. For years, it's been a source of both joy and frustration. Joy for those who bought low and sold high, frustration for those priced out of the market or stuck with underwater mortgages. But lately, the housing market has been feeling a bit under the weather. Remember those bidding wars and skyrocketing prices we talked about earlier? Well, they've gone the way of the dodo bird. Higher mortgage rates have put a damper on demand, and the market has cooled considerably. In some areas, prices are even starting to decline. Now, a cooling housing market isn't necessarily a bad thing. It could be a healthy correction after years of unsustainable growth. But if the market takes a nosedive, it could drag the rest of the economy down with it. So is this a cold or something worse? It's hard to say for sure. Keep an eye on those interest rates and housing prices. If they continue to fall, it could be a sign that the economic sniffles are turning into a full-blown flu. But we must look out for global dominoes. Will China's slowdown topple the world? We live in a globalized world, interconnected by trade, finance, and the internet. What happens in one part of the world can have ripple effects across the globe, and right now, all eyes are on China. The Chinese economy, once a powerhouse of growth, has been slowing down. The reasons are complex and multifaceted, but the potential consequences are significant. China is a major player in the global economy, and its slowdown could send shockwaves through the system. Think of it like a game of dominoes. If China falters, it could trigger a chain reaction, leading to a global economic slowdown, or worse, a recession. Of course, this is just one possible scenario. The global economy is a complex beast, and there are many other factors at play, but the message is clear. We don't live in a vacuum. What happens in China or any other part of the world can and does affect us all. And now we enter the conspiracy corner. Is this all part of the plan? Now, we've talked about economic indicators, global trends, and the possibility of a recession. But what if it's all part of a bigger plan? What if there are unseen forces manipulating the levers of power, orchestrating a global economic collapse for their own nefarious purposes? Okay, we're entering conspiracy theory territory here, but hey, every good economic thriller needs a villain, right? And there's no shortage of candidates, shadowy cabal of bankers, power-hungry politicians, lizard people disguised as world leaders. Take your pick. But in all seriousness, while it's tempting to believe in grand conspiracies, the truth is often far more mundane. Recessions happen. They're a natural part of the economic cycle, a result of a complex interplay of factors, both predictable and unpredictable. That being said, there's no harm in a little healthy skepticism. After all, knowledge is power, and understanding how the world really works, even the shadowy underbelly, can help you make informed decisions and navigate uncertain times. But hey, let's not panic. Let's prepare. We've explored the potential for a recession and examined the economic tea leaves. Now let's get down to brass tacks. What can you do to prepare? First and foremost, don't panic. Easier said than done, right? Panicking leads to rash decisions. Instead, focus on what you can control. Start by reviewing your finances. Do you have an emergency fund? If not, now's the time to build one. Aim for at least 3 to 6 months' worth of living expenses. This will provide a financial cushion if you lose your job or face unexpected expenses. High-interest debt can be a major drain on your finances. Focus on paying down those balances. Finally, think about your investments. Consider diversifying your portfolio. Explore other asset classes like bonds or real estate. Is there a silver lining in the eye of the storm? It's easy to get caught up in the doom and gloom of a potential recession. But remember, every cloud has a silver lining. Recessions can create opportunities both for businesses and individuals. For businesses, a recession can be a time to streamline operations, cut costs, and innovate. It's a chance to reevaluate strategies, identify new markets, and come out stronger on the other side. For individuals, a recession can be a time to reassess priorities, explore new career paths, and even start a business. It can also be a good time to invest, as asset prices tend to be lower during a downturn. Of course, this is not to say that recessions are a good thing. They can be painful and disruptive, both economically and personally. But it's important to remember that they're also temporary. The economy is cyclical, and what goes down must eventually come back up. So while it's prudent to prepare for the worst, don't lose sight of the potential opportunities that a recession can create. With the right mindset and a bit of creativity, you can weather the storm and come out stronger on the other side. Navigating the world of investing can feel like walking a tightrope during a zombie apocalypse at the best of times. Throw in the possibility of a recession, and it's enough to make even the most seasoned investor break into a cold sweat. So, what's the play? Do you dive headfirst into the stock market hoping to catch the bottom? Or do you run for the hills, stashing your cash under the mattress and hoping for the best? The answer, as with most things in life, is a bit more nuanced. There's no one-size-fits-all approach to investing during a recession, or any time for that matter. It all depends on your individual circumstances, risk tolerance, and investment goals. That being said, there are a few general strategies to consider. Diversification is key, spreading your investments across different asset classes to reduce risk. Value investing, seeking out undervalued companies with strong fundamentals, can be particularly effective during a downturn. And then there are alternative investments like precious metals, collectibles, or even fine wine. These can provide a hedge against inflation and market volatility. And some, like rare wines, can be quite enjoyable to liquidate, so to speak. But how can we ride out the storm? It's the American dream, right? Owning a piece of the pie, building equity, creating a home. But what happens to that dream when the economy takes a turn for the worse? Recessions can have a significant impact on the real estate market. As we've seen, rising interest rates and economic uncertainty can lead to a cooling market, with declining prices and fewer buyers. But it's not all doom and gloom. While recessions can be challenging for homeowners, they can also create opportunities. For those with cash on hand, a downturn can be a good time to buy, as prices are often lower and there's less competition. And even if you're not in the market to buy or sell, there are things you can do to protect your investment. Make sure you have a comfortable mortgage payment that you can afford, even if your income takes a hit. Consider refinancing to a lower rate if possible. Ultimately, the key to navigating the real estate market during a recession is to be informed, be prepared, and be realistic about your expectations. So, is a recession looming? The economic crystal ball remains cloudy, offering glimpses of both storm clouds and potential sunshine. The truth is, no one knows for sure what the future holds. But here's the good news: we're not powerless. By understanding the economic indicators, preparing our finances, and making informed decisions, we can navigate whatever challenges lie ahead. Remember, knowledge is power. Hey, stay informed, stay vigilant, and most importantly, don't panic. The economy is cyclical, and just as surely as the sun rises and sets, this too shall pass. In the meantime, let's focus on what we can control, weather the storm, and emerge stronger on the other side.